In this video, we'll talk about why TASR is better than hedging for your trading. You'll also see in this video the exact rules and symbol strategy settings, everything about the details of a strategy if you had put $10,000 into would have turned into $178,000, and it is the subject, it is the example that we're using as far as a strategy goes today. So this is not investment advice. Please consider the risks carefully and speak with a personal investment advisor. My name is Andrew Faldy. I have 15 years of experience trading on Wall Street for hedge funds and individual investors, and I've created many award-winning systems that have been trusted by thousands of traders around the world. And here's what we're going to cover in this video. First is a common hedging mistake. Second is a better solution to protect your account from certain types of risks. Third is the 4-step framework to remove the guesswork and see smoother and more consistent account growth. And the exact rules of the strategy that's described in the video, lots and lots of proof in multiple symbols that the strategy can be very effective. And then we'll discuss briefly the #1 tool of modern hedge fund managers. So years ago, my approach to the market was very singular in focus, and that was market neutral options trading. So I would trade large broken wing butterflies on index options. If you don't know what that means, don't worry. The short version is that these are trades that make very good income and money if the market doesn't move very much, preferably doesn't move at all over a period of time. And they can be risky and lose money and be challenging when the market moves a lot. Okay, so the issue, market neutral option spreads can make a lot when the market moves slow or sideways, and strong trends and sudden changes can be challenging, and depending on how large they are, could even be quite devastating. So my first idea when I wanted to control the risks better so I could trade bigger and bigger in this strategy is I thought I'll use technical signals to buy and short the S&P 500 in the direction that it's moving. So if I have a position and the market starts to move up, then I will buy either the S&P 500 futures or the S&P 500 ETF. And if it's going down, then I will sell and possibly short the same instrument in that direction, so that if it continues in that direction, I'll have a quote-unquote hedge. So the problem is that type of strategy does not work very well. Going long, going short. In fact, going short is very bad. These are just the results of 220 example trades going long only over a generally bullish period of time. And it's just really not very effective. And that's what I had to solve. So thankfully, I had experience in New York on Wall Street trading with many traders and 7- and 8-figure traders. And I noticed something, that the consistently profitable 7- and 8-figure directional traders almost never trade ETFs. So that's when I understood the importance of asset selection for different types of strategies. I was in one asset because it was the best paired with the strategy and the approach that I had. And for directional traders, they would not trade that same asset because it was not good for directional trading. And this is when the TASR method was really born and really became a part of it. I hadn't named it or abbreviated it in any way at the time, but this is the way it's summarized. So here's how TASR works. It is these 4 things. TASR means thesis, asset, strategy, repeat, and also the R can trigger you to remember to focus on risk mitigation. So starting at the top again, thesis is an opportunity or pattern with potential. So it doesn't have to be a model. It doesn't have to be systematic. It doesn't have to be a trade that's ever worked before. You could just believe that something's overbought, or you could believe something about the market, or you can model things and prove that this is a pattern that develops over time. And that can be a mean reversion pattern, an income pattern, a momentum pattern, an event-driven pattern, anything that is a thesis, an idea that you can explain and kind of justify with logic, right? The next is select the best assets or instruments for the thesis. So which stocks or ETFs or options or futures or crypto or whatever it is, real estate, private equity, whatever it is, what is the best asset for the thesis that you have? And thesis, like I said, can be an observation or just an idea about something you think is an opportunity. And then third is, what is the strategy? So how and when do we buy, adjust the signal, adjust the position, and sell and or go short? And then fourth is to repeat this three-step process above with a focus on risk mitigation. So we're going to repeat, preferably with an uncorrelated or even better, inversely correlated thesis. So whatever our primary thesis, like mine, was that indexes tend to move slowly, so market neutral options trading would be more effective. So actually that's what this example is. So my thesis was indexes move relatively slowly and have more stable price ranges, making them ideal for market neutral and mean reversion strategies. So what's the appropriate asset for that? Well, I could use the lower priced ETFs, I could use futures, but really the most efficient asset instrument is the higher price, higher underlying price SPX index options. So it's a higher underlying price. That means fewer options contracts have to be traded. It has a low cost ratio. Costs are your commissions and slippage related to the average return of each trade. So the index options have a higher price, so lower cost ratio. They're relatively liquid. They're liquid enough, more liquid than other indexes, and relatively low risk. There is a lot of risk in these trades. A moderately large crash, the type that you see at least once every 5 or 6 years, can be quite painful. And then every once in a while, like a 20-year or 30-year event, could wipe you out if you put too much money in it. So it is a risky trade, but because of the asset, it is the lower risk of them. You could trade a little larger, but it still does have that risk in it. So what's the specific strategy? So just knowing the asset, SPX options, still don't have the when do I buy and sell, what do I buy and sell. So that I had a specific, and do have a specific broken wing butterfly system called the net zero options trade, which has been largely unchanged for 10 years at this point, and very effective. So then the R, okay, I only showed you the first 3, so what's the R? Well, first we'll talk about what I tried to do and how that had mistakes behind it. So R is repeat with a focus on mitigating risk. So the risk is too much movement hurts market neutral trades. So my original thought and solution was I'll trade SPY or ES futures, the E-mini S&P futures, in the direction of momentum to protect market neutral trades. However, the mistakes are, number 1, I was starting with risk control as my only goal. I didn't have a thesis about how do markets make money from movement. I just had a problem to solve. And so really all this was doing was saying, I just am going to use this as a hedge. And often, unfortunately, the word hedge is just our comfortable word for saying, I'm going to take this other trade so that I feel less risky. So it feels like I'm taking less risk over in this other position. But often it's inefficient, adds additional costs, may not protect you as well as it could. And it's really just a psychological crutch to not close the position or trade at the correct size in the first place. So that mistake led to a hedge that was ineffective, inefficient, and didn't really improve my risk-adjusted returns. And the second mistake was trying to force a directional strategy to work on a slow-moving asset. So I had the wrong asset combined with a certain type of strategy, and they were not a good fit because I did not do it in the correct order that's being prescribed. I didn't have a top-line thesis that was logical and provable. I did not have the right asset for that thesis, and I did not have the right strategy for the right asset. Okay, so I was not doing these things. So applying TASR instead, the new thesis is this: tech stocks can have monster trends when indexes are rising slowly. So in this case, I'm only focusing on the upside risk, which if you saw that profile before, or if you know about broken wing butterflies, you say, well, there's not really a lot of risk to the upside. The reality is many of your losses on those types of trades are on the upside. And mild upside moves can create gamma related losses in options trades they will chip away, and actually markets climb over time more than they crash. So this is a very important risk to cover. So the new assets are big tech stocks, right? So I'm going to trade big tech stocks because I have a thesis that technology stocks can have monster trends, meaning they can go up 20-30% when the rest of the market only goes up 5 or 6%. So that would be a very effective way to try to get long. Also, when I could buy the S&P 500 ETF and then sell it on a reverse signal, I may make a tiny bit or lose, and some of these tech stocks will have had a nice big run during that time. So the strategy I'm going to apply, and I'm going to give you more details on the rules in a minute, but the strategy is to buy dips in a bull trend and then sell when the trend ends or turns, okay? So we're going to use a 20-day average and a 9-day average. If the price is above the 20-day average, and again, I'll recap this in a minute, that's the bullish trend. If it gets below the 9-day average, that's the quote-unquote dip opportunity or mean reversion opportunity. And so running that same strategy across the S&P 500 ETF down here at the bottom left, that's the results of this strategy on that ETF, and the same strategy, same time frames, same settings, same everything, same size, etc., across the major big tech stocks that are shown, generated significantly more results. One of them, Tesla, generating 10 times the profit of SPY. 10 times profit. And you ready for this? It even has a shorter history. It was given less time to make that because it's not been around that long. So very, very effective across the board. Here's the individual returns. So across the bottom lists each trade. So there's almost 150 trades in here. And then on the left is the returns. Each of these trades are $10,000. So you can see the total return over these collected trades. And you'll notice that each of these equity curves or return graphs have a different shape, which means these are not totally correlated systems. And by the way, these are completely uncompounded returns. If you were to buy and hold those stocks, it would appear that they can make a lot more. But the reality is when you trade, you can do the same thing. Each profit, each time you get out of a trade and you get back in, you can put your profits back into the trades. And with that, the compounded return, putting all profits back into the ETF, $10,000 would have turned into $14,000, actually just a little bit less than that. And Tesla would have taken $10,000 and turned it into $118,000. And Apple would have turned $10,000 into $178,000. $178,000 is quite different than 14. And really, we can talk about the sheer dollar amount difference in the pricing there. But another thing to consider is it also means you just don't have to put as much in. You can put $1,000 into each of these trades in your account, depending on your size and what's correct for you, and allow those trades to compound out of that. So here are the strategy rules for those who are interested, and this is more detailed out if you want to take a screenshot or take a picture of this. Very, very simple, really almost too simple of a trading system. There's a lot more we can do with volatility sizing, additional filters, better entry, stops, limits, etc., partial exits, lots and lots of things. But I love to test very simple strategies to prove a concept and prove a point, and then add the complexity later. So the really simple strategy is if the price is above the 20-day average, we call that more or less momentum. So that's the medium-term momentum. And price is below the 9-day average, which is kind of like a mean or an average, like the short-term mean reversion level. Then we buy the next bar at the open. And that'll be in all these graphs was either $10,000 per trade or $10,000 plus reinvestments. And then selling when the price crosses back below the 20-day average, then we sell. Okay? So above the 20, we're ready to buy, but we're going to wait for the first dip. Then we're going to hold until it finally gets back below the 20, and that allows us to have some large trends. So here's an exact representation of this. Buying is right here at the left. This will be the sale, but we're going to number these out and show. So here, the market had gone up but pulled back a little bit. So there's our entry point, and that's buying the dip, or consolidation really is what it appears in this one. And we're going to hold all the way through, not just because it gets back above the 9 or anything. We're going to hold all the way as long as the trend lasts. And then we're going to exit on the trend change. So on the end of this bar here, it got below the 20 period moving average. So we sell the open of the next bar. And then we stay out during a bear trend. Now this was a picture perfect example that I absolutely scrolled through, found, and plucked out of the history to show you how amazing this can be. But please know that this is not a typical result. There's plenty of losses and plenty of much smaller trades as well, but it nets out to a very high performing trading system. And by the way, that same period of time, the SPY or the S&P 500 ETF appreciated by 6.2% compared to the move in there that we just saw on that chart was 17.95% in Apple. So what's really going on? How do we take this information and feed it into our TASR or feed it into our thesis? Well, the reality is high beta stocks is what we're looking at can and tend to skyrocket in strong markets while indexes just inch along. And so we apply those two theses together. So we're going to do bullish trades on high beta stocks, and we're going to do market neutral trades on indexes. And the beautiful thing there is you don't anymore have to wake up in the morning and try to decide if the market's going to go up or sideways or down today, because you have the right strategies applied to the right assets following the right theses or big ideas. Okay. And then you've gone through the process of saying, well, I have this, like me, I had my inching along index strategy. Well, one of my risks that I was dealing with a lot was on the upside, I would take losses, which is really annoying, by the way, when the market goes up and you lose money. So I covered it with high beta stocks. Did that many years ago. It's been working ever since. Very, very effective. But I had a new problem at the time. That is, how do I manage all these new strategies and symbols? Before, I had one index to follow, maybe two I would do a second trade on, and one trade in each. Every once in a while, I would start a second trade. So I'd have one or two instruments and 2 to 4 trades, and that was it. But now I want to get into all these high beta stocks, and I want to have all these positions. Some of them were on hourly charts. There were lots of reasons to buy and sell, and it was going to be very overwhelming very quickly. Well, the answer is very simple, and that is to automate it. So automated trading is the answer. That's the answer I applied, and it has been a very effective way to add all these strategies in with less work, less stress, and way fewer mistakes. So automated trading facts, by the way, you may recognize a couple of these names, but Jim Simon's Renaissance Fund. It is, I was going to say was, but Jim Simon's Renaissance Fund, which still exists, the late Jim Simons started and founded, is 100% automated. You can go find interviews with Jim about that. 100% automated, zero discretion of any kind. It's all systems that have been created and automated, and they trade up to thousands of stocks each year. Larry Hite, well known for developing systems, 100% automated. Bridgewater, the largest hedge fund. Jim Simons is Renaissance, arguably the highest performing, the highest return hedge fund in the world. Bridgewater being the largest hedge fund and very strong results. 99% automated is how they put it. I don't know what the 1% remaining is, but I guess some executive intervention from time to time. And all hedge funds combined, it is estimated that over 80% of the trades inside of hedge funds are automated algorithmic systems. Well, how does that contrast to retail traders? Most retail traders are 100% manual, and more often than not, very discretionary, if not completely discretionary, in what they buy, when they're going to hold it, how big the trade is, etc. And even if you do follow a rules-based system, it most likely is being traded manually and not very well diversified with uncorrelated systems. So if you want the results of top traders, which I'm sure you do, then do what they do. Use automated trading systems. So recap of what we talked about. Use the thesis asset strategy repeat method, TASR, to add uncorrelated systems for smoother growth. And do that rather than trying to overprotect and overhedge your positions or second guess your positions out of fear of those risks. Find strategies that thrive on those risks and develop them and implement them. And automate your systems to reduce mistakes and increase the number of opportunities you're in. So if you're ready to become a systematic trader, I invite you to join us over at edgenavigator.com. So edgenavigator.com. And depending on where you're watching this, go ahead and like it, subscribe, follow along, and there'll be plenty of more great content for you.